Now that earnings season for the full year 2018 has wrapped up, I'm speaking with Peter Warnes from Morningstar about a season that he saw as largely in line with expectations. But there are a few standouts, including the resources and healthcare sectors, and also within the dividend space, where the payout ratios continue to be quite high. Peter, thank you very much for your time today.
Lovely to be in, Glenn.
Now we've seen that's another earnings season that's been crossed off the list, another full year season. Overall, you've said that it was a pretty pleasing results across the board, and it was well anticipated by the market and by our analysts here inside Morningstar. So can we talk through a bit about what your thoughts are in general terms?
Yeah, Glenn, I mean, overall, the reporting season was, as I said, pretty good. Average increase in earnings for the ASX 200 was about 9%. Resources doing much better than the rest of the market, up about 20% or a bit more, and the ex-resources only up about 5 or 6%. Weighted average being affected by banks and telcos. So overall, a good reporting season. But I think the highlight really was the dividends. Dividend growth exceeded earnings growth, which is always a nice way to finish for shareholders.
Well, just on that, I mean, how did the total payout figures this year compare to last year? And is it something that you think is it sustainable that they can stay up at these levels going forward, or have we seen a peak in dividends?
Yeah, Glenn, that's a very good question, because all shareholders like to bank the dividends a couple of times a year. Look, this year I suspect what was happening was that management decided early on maybe they weren't going to pull the trigger too much on investment, and their balance sheets are in pretty good shape. So they didn't have to pay down a lot of debt, and they didn't really push the pedal on investment, so that allowed management to reward shareholders more. Free cash flow has only got 3 buckets, and so we didn't have to pay down too much debt. We didn't push our foot to the floor on investment, and so that gave them more allocation for shareholders. And payout ratios generally rose because of that. So payout ratios are higher, and as well, a few more share buybacks. So capital management initiatives were, front and centre. Now, my gut feel is that's not going to be sustainable, and so I think what you're going to see is a flattening in the payout ratios and a lesser dividend growth going forward. But this year, in the numbers I've seen, total dividends for the reporting season just passed was about 40 billion, up from about 35 billion last year, which is a bit more than 10%. And I said that the overall earnings were up about 9%, so that lines up there. And as I say, I think the payout ratios will start flattening from here on in. As maybe, well, hopefully, and certainly the Reserve Bank's hoping that non-resources or non-mining investment starts to kick up.
Are there any red flags in that result, in the dividend specifically again, that that CapEx is too low, that businesses are they a bit skittish and not wanting to necessarily grow their businesses? Is there uncertainty, or is it just something that it is happening in a more balanced fashion where they're not investing all their free cash into growing businesses, and they're not paying it all out either? They're kind of balancing.
Yeah, well, look, all businesses are trying to run lean. I mean, as I said, the results were pretty reasonable, but what was a little bit disappointing, and where you saw initial market reaction was negative, was if the forward guidance, in other words, the guidance to 2019 was a bit soft. And generally speaking, it was soft, or softer than anticipated by the consensus view out there. And you saw quite a number of analyst downgrades because going forward the guidance just didn't match up. So as I said, the companies are running lean. They really are saying margin pressure is quite intense, and going forward, I think it's quite opaque out there. Right? It's not it's the horizon is got some clouds on it. I don't think, and I think that's one of the reasons why you're not getting wages growth to the extent that the Reserve Bank would like, or that the results probably would suggest, because management don't want to, increase one of their major expense items is wages and salaries. If they tweak the wage rates, they're locking them in. What's happening is that there's more overtime and there's more numbers employed, and that's what's supporting household income at the moment, not higher wage rates. And so, you've got raw material costs, imported raw material costs going north. You've got energy costs still being a very, very significant part of the whole equation. And so management's a little bit gun shy, and they're saying, okay, look, let's just wait a second before we go and say, right, we're going to push the button on major growth expansion.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.